Hi, everybody. If you're new, welcome. I'm the investing teacher, a high school science teacher that also teaches others how to control their paycheck through trading. I've been successfully doing these strategies for over 7 years now, and I'm the founder of ThetaTraders.com, an online platform that provides one on one and group coaching sessions and option selling alerts. I have provided previous one on one sessions from other clients in the past in this channel. If you find the end of this video helpful, consider joining a 7-day free trial membership at ThetaTraders.com. Link is in the description down below. Let's get started. Hi everybody, this is Lance from ThetaTraders.com. In this video, we're going to be going over what is the expected move, how to find the expected move using Thinkorswim and Tastyworks, and also how to place possible trades using this expected move for our advantage. If you like this video, like, share, subscribe, all that good stuff helps out the channel. Definitely appreciate all the support we have, and just get right to it. So what is the expected move with options? In this video, we're going to go over what the expected move is, how to easily find these expected moves, and then considerations on where to place your trades. So the term expected move in options refers to the anticipated range of price movement for an underlying asset over a certain period of time. It's typically estimated using statistical models like the Black-Scholes model and also implied volatility levels. So when you're looking at different positions and different time periods, the expected move will be based on a bell curve distribution that you'll see shortly. So the expected move is a measure of the potential price range for the underlying asset over a particular time horizon as implied by the options market. So it represents the expected percentage change in the price of the asset up or down over the specified time period. What's useful is the up or down part. So if you know the expected move within the bell curve distribution, you can sell put options that are lower than the expected move and then sell call options above the expected move. You either do this through a strangle or from an iron condor. So this shows a bell curve distribution. If you're looking at, say, grades in a test, I'm a school teacher, so give a lot of grades out. Typically, you'll see some people completely bomb the test and get really low grades. Some people do amazingly well and get 100. But most people within a certain range here is typically like a B or a C in the actual test grade. A standard deviation is 34.1% either above or below the average of all the grades. And if you have a large sample size, you'll see this happen time and time again in test scores, also with different stock prices. So the stock price would be starting at the center, and the expected move essentially would be a 34.1% chance that it would be somewhere from here up to the first standard deviation going upward. And that's also a 34.1% chance that it would go from the middle to the left side. About 68% chance that it's going to fall within that range. And what's interesting about options is typically the implied volatility is a little bit off compared to the historical and the current implied volatility. So when you're looking at the future, a lot of times the volatility is higher than what the actual historical is. So those percentages are actually a little bit higher in most trades. So what changes the expected move when you're looking at different periods? The main one is the time left for an option to expire. If you only have a few days before an option expires, it's not going to dramatically move in one direction very much. Also, the implied volatility. If something's more volatile, you're going to have bigger swings. It's going to be a wider bell curve in Thinkorswim brokerage platform. All you got to do is type in the name of the stock or even futures. And then on the right side, you'll see these expected moves as a plus or minus with the numbers associated with it. So if you look at, say, 1 day away, the expected move in SPY is 3.8. So it'd be 3.8 higher than 4.09 or 3.8 lower than 4.09. As you go down in time, obviously SPY could be moving more because it has more time to do so. And you'll see the expected move increase as you get further out in your expirations. For Tasty Trade, it's almost the same idea. Let's type in the ticker symbol. This is for SPY. And then on the right side again, you'll see the expected moves. Now you'll notice in Tasty Trade is usually slightly different than in Thinkorswim. Here it said 3.3, and the other one was 3.8. I usually use the Thinkorswim one just to be a little bit safer in my strike prices, and then I could use that for my possible expected moves. So how do you find the expected move using a Thinkorswim brokerage? All you got to do is type in the name of the ticker symbol on the top left, and then on the right side of the screen, you want to look at the plus minus numbers, and that shows how much higher or lower the expected move is. That's again around 68% of the time. The price will fall above or below that range. So what that means is if you're at 409.19, it's about a 68% chance it will be within 3.8 smaller than that or 3.8 higher than that. Notice as you get further out in expirations, your expected move goes up. For a Tasty Trade, it's almost the same idea. Type in the ticker symbol. On the right, we'll have your expected moves. I tend to look at Thinkorswims over Tasty Trade because they're a little bit more conservative. The 1 DTE was 3.8, and here it's showing 3.3. So I usually want to go a little bit safer on these and use the Thinkorswim numbers. Here's some possible ways to place trades using your expected move. You want to consider selling right outside the expected move because there's a good chance it falls within that range of the bell curve, and then you want to be a little bit safer than that. So you typically want to go around 0.15 delta or go around twice the expected move at 0.05 delta. Now, there's a good chance the stock will not reach that price at expiration, and then your options will expire worthless, and you could make full 100% of your premium. Typically, though, at datatraders.com, we tend to sell them and then buy them back at 50% profit because then it recycles your funds. You could do another trade, and it tends to be a little bit higher rate of return than just waiting until it expires. So here's a sample trade that you can consider taking for Monday. SPY is currently at 409.19. Your expected move 40 days from now is 21.23. So what we're going to do is consider doing an iron condor. Your sold put will be 41.19 minus the expected move of 21.23 or 387. You want to go a little bit further than that. So you're going to look at the 385 strike. That's right outside your expected move. And then you're going to buy a 380 put that ends up being a 5-with spread and uses only $500 in buying power. For your call side, we're going to add 21.23 and you get 432.42. Want to go a little bit outside that expected move. So look at the 435 strike, and you're going to sell that one, the call side, and then buy the 440 call. This is how it'll look on Thinkorswim. If you're on Condor, selling your puts right outside the expected move at 385 and 435. You're going to buy the call 5 higher, buy the put 5 lower than the sold options. You could take 108 in premium, and then you buy to close it at about 50% profit. You buy to close at 0.5 or so. In the end, you'd get $58 in profit. Only uses $500 in buying power. And that's how you could get 11.6% return in your money in only 40 days. Now imagine doing that over and over in many different ticker symbols, many different expiration dates. And that's what we tend to do a lot at datatraders.com, using our probabilities to our advantage to get good profits and returns. So again, at datatraders.com, we do these every day. Do longer dated put credit spreads, longer dated cash secured puts. We can do these with futures, options, and look at many different types of stocks and futures, different expiration dates as well. And we use those expected moves, usually go a little bit further out, sometimes twice the expected move to make relatively conservative and safe trades. So if you're interested in learning more about what we do, you can have a one-on-one Zoom session with me and join about 140 right now like-minded individuals and how to sell options to make consistent profits. You can join a free 7-day trial at thetatraders.com. Everyone else, happy trading, and we'll see you guys